the interest rates are falling down. Well, as much as this sounds like a good news because the rates are falling despite the Bank of England base rate increase, we really don't know what the catch could be. But before we dive right into the topic, 90% of you have not subscribed to our channel, so it'll be awesome if you can subscribe to our channel and also give us a thumbs up if you liked this video towards the very end. And if you have any questions at all, don't forget to drop them down on the comment section below. So to discuss what the catch is behind the interest rate decreases, I have Iftikhar Mohammed, who is a trained advisor and has been in the industry for 10 plus years. Hi Ifti, it's been some time since we last met. How's 2023 been treating you so far?
Oh, very good. 2023 has not been bad. Been in the island of paradise, Sri Lanka. So people have been very good to me here. So I'm enjoying Sri Lanka. So 23 hasn't been bad at all.
So have you got a New Year's resolution already for 2023?
Well, I think everybody should. I do have one as well, but I have few actually, to be honest. But, this year is going to be a tough one for a lot of people. So, cutting down costs and also paying as low interest as possible on my mortgage is definitely in my priority list.
Yeah, I'm pretty sure many of the people would probably have the same resolution as well, because it's been a pretty crazy time for many people. They must be stressed out with their mortgages. So now my first question is, what exactly is the catch? Because the Bank of England base rate went up to 4%, but the banks have been reducing their rates every single day. So, what exactly is the story behind this inverse relationship between the two variables?
Okay, it's a very good question, Pradesh. I think people get confused as well, right? As soon as Bank of England, this has been happening, like you said, 10 times now, they announce that they're going to increase rates, people start panicking, our phone lines start ringing, and people are just worried about it. But don't worry, it's not for everybody to be worried about, because if you're on a tracker rate or if you're on a variable rate, such as a standard variable rate that the banks have, yes, you do have to worry about it because your rate's likely to go up. But maybe if you're on a discounted rate, you may not have to worry about it, because even though the Bank of England has increased the base rate, the lender may not increase the base rate. So you might not have to worry about it. Just diving into the question about fixed mortgages, yes, you're right, fixed mortgage rates have been coming down because there's no 100% correlation between a fixed rate and the Bank of England base rate, because the fixed rates are based on a different concept. Now, if you take a fixed rate, say for example a 2-year rate and a 5-year rate, so it's based on what's happening in the money markets, right? So banks in general, they borrow money from the money markets. That's where majority of the borrowing takes place for banks. So if you look at a 2-year rate, this 2-year rate is based on the 2-year spot rate, more or less. So for example, if you look at the 2-year spot rate, now the normal fixed mortgages are more or less in line with that. But that doesn't have 100% correlation with the Bank of England base rate. Likewise, we find 5-year rates which are a little cheaper. The reason for that is it's again connected to the swap rates or the money market rates. So it's kind of correlated more or less to those rather than the Bank of England base rate. So that's why you see the fixed rates dropping, but Bank of England going the other way around and they're increasing rates, right? So there's no 100% correlation. It's mainly due to that reason.
Thank you, Ifti, because that's something not a lot of people know, and that's quite useful to know. So landlords, don't worry, we will talk about the buy-to-let side of things, but before we dive right into buy-to-let side of things, let's talk a bit about the residential side of things, the residential mortgages, the first-time buyers rather. So many of the first-time buyers benefited a lot from the 0.1% Bank of England base rate a couple of years ago. And we had a lot of first-time buyers swarming in, and there were like so many applications. But what is your message to the first-time buyers out there right now? Because the rates have gone up ever since. However, in the short run, or rather in the short term, at least now, the rates have been coming down. So would it be the best time for them to go for a mortgage?
Very good question again, Pradesh. Because with first-time buyers, obviously, like you mentioned, they benefited some time ago with the drop in interest rates, right? But what we have to realize is the Bank of England base rate at 0.1%, that's something we never seen in history because it's been so low. I don't think we can expect it to be at that level anymore. But now we are sort of coming back to normalcy, and the rates are supposed to be where they are, right? So because rates are supposed to be in line with the inflation targets. So if you are looking at something like that, I don't think you can ever expect the rates to be low. So the answer to your question, as a first-time buyer, yes, this might be a good time for you to buy a property because rates might drop a little bit more further. We don't know because it's something that we don't have control over. But on the other side, what we find is some of the properties have actually lost value, right? So we find that, looking at various research that's, been published, the property market, the values have come down. So because the values have come down, it may still not be a bad idea because you may pay a little bit extra interest, but you might get a property a little cheaper. But maybe you can go for a shorter term deal, like a 2-year deal, and if the rates drop further, you'll benefit from that, right? So you might still benefit from, a lower house value, and also you might benefit from, the interest rate drop in future. So you might still not be in a bad position to do that.
Right. Actually, that brings to my next question. If you mentioned that if someone goes on to a 2-year deal, they could possibly benefit from lower interest rates by the end of the 2-year term. However, there is a conundrum between the mortgagors at the moment, whether to go ahead with a 5-year deal or a 2-year deal. Yeah. So what exactly would be the right concessionary period that they could actually look at?
Very good question. The answer is we are not very sure. At the moment, there's a theory to say that if somebody goes for a 2-year deal, obviously the rates are expensive and the 5-year deals are cheap. End of the day, that usually happens if you're expecting the rates to drop in future, because I think the swap rates are based on that, because if the money markets think that the rates are going to drop in future, they will offer longer term deals a little cheaper. So I think, the next couple of years might be a little tricky. Maybe another 1 year, 1.5 years might be a little tricky, because I think the Bank of England will increase base rates if they think the inflation is not under control. Obviously, as of now, it's still not under control. So that might go up a little bit, but then, it's expected to stabilize and drop, further in future once the inflation is under control. But at what point that will happen is something nobody really knows, right? But I would think, things might get better after about a year or maybe 2, right? For sure, there should be some kind of change at that point. So that's why we see these 5-year rates lower as well. But, nobody can give you that answer for sure. It's a sort of a crystal ball question. But based on what analysts are saying and based on what we are hearing, I think that's kind of what is expected.
Thank you for that insight, Ifti. I think for many of you first-time buyers out there, if you're still confused between choosing a 2-year or a 5-year fixed deal, I think it's best to consult your mortgage advisor or talk to a bank, because your circumstances might vary from person to person. So it's always best to get some advice on that so that you can get the most suitable product for you. Let's talk about remortgagors and home movers. So for someone who has had the sweet taste of lower interest rates, just because they happen to fix their rates a couple of years ago when the rates were quite low, definitely they're going to find the rates quite expensive when they do the remortgage. And for someone who's moving homes, it's going to be the same thing as well. So what is your thought process on how they could manage their mortgages if they are to remortgage or even move homes right now?
Okay, that's a very good question, Pradesh. Again, with people remortgaging and people moving house, what I sometimes find is a lot of people borrow maximum. Right? I've got clients who say, look, I've got a 10% deposit. How much maximum can I borrow? And their purchase price is generally based on that. But what happens is, because they're pushing to their maximum, let's say they had an interest rate of 1.5% from 2 years ago, they're in for a shock, right? Because you're not going to find a rate less than 4%. It's very difficult, right? I know there's one bank who does less than 4% as of today, but it's going to be very difficult. So effectively, the interest rate is almost tripled for this particular person. Now the problem we have is, that means now you'll have to pay, depending on the loan size, you might have to pay £200, £300, £500, even £1,000 more, because I've seen clients having to pay £1,000 more because their loan size is big. Now that's something that people are not ready for, right? So they are likely to have a problem. Not everyone, but some people will, because they've sort of built their lifestyle based on the mortgage and based on what they're earning. Suddenly £1,000 extra bill, you're going to have a problem. So my advice to those people is start planning in advance. Don't wait for the last minute, just start planning in advance. Just make sure that, let's say you are likely to pay £1,000 in advance, speak to an advisor and ask the advisor, okay, how much is my mortgage going to be in future? So if you know how much it's going to be in future, just plan in advance. Just see, okay, if I am minus £1,000 more every month, how would it feel like? So just do that drill before it comes to the real date, right? So then you know how to manage with that £1,000 extra bill, which means you might have to cut on your entertainment, you might have to cut on certain other expenses to make sure you pay the mortgage. So you can plan that in advance. There are other things that you can do as well, right? But that is a practical thing. But there are other things you can do. Again, advisors can help you. Sometimes if you really can't afford it, you can extend your mortgage. So let's say you got 25 years left in your mortgage, you can potentially increase it to 30 years. So that's something you can potentially do. It's not a good practice if you're doing that, because what happens is you're taking time to pay off your mortgage, right? So if you were supposed to finish your mortgage when you're 65, now you're going to finish when you're 70. So that's not a good thing, right? But sometimes if you don't have a choice, that might be better than defaulting on your mortgage, right? So you can look at things like extending your mortgage. Also, if you have spare cash, right, maybe it's an idea to pay off some of your mortgage, right? So let's say you got 50,000 sitting in your bank account doing nothing much, right? So maybe you can settle your mortgage. So then your mortgage amount comes down, effectively your monthly payment comes down, and you might be able to budget that, right? So it helps you. That's something you can do. There's another option like an offset account, right? Some people make use of that. If you have spare cash and you don't want to pay the mortgage, still it's okay. Put your money into offset account and the amount of interest you pay will reduce. So if this 50,000 you put to offset account, and let's say your loan was say 250,000, now you're going to be paying interest only on 200,000. So that could help your mortgage as well. There is other options like say get onto an interest only mortgage. Again, it's not something I recommend every day, right? Because interest only, the biggest problem you have is if you go on interest only, you might have a loan at the end of the period and you may have to pay off that loan and you might not have the money to do that and you won't own the property because you still owe money to the bank. But again, push come to shove, that may be an option for you to consider. Again, these are like a little bit more serious issues, right? So you may need advice on this. So don't just say, I need an interest-only mortgage, because that's probably not a good thing to do. So there are definite alternatives out there. There are two other practical things that you can do. Like I said before, it may be an idea for you to look at your expenses, because that's an important point, right? Look at your utility providers. Maybe you can switch to providers where it will save money. Look at some costs, because I know people who spend on Netflix, they spend on Amazon Prime to watch the videos, and Breadbox, whatever not, right? So these can really be cut down because sometimes you duplicate these expenses. Think before you spend, right? You probably don't have to spend so many things, right? Maybe if you're eating out twice a week, maybe you can eat out once, or maybe not eat out and start cooking at home. So there are things that you can potentially do to cut down your expenses, because the mortgage might go up, right? And you may not have a choice. And there might be certain discretionary expenses that you can reduce. So that's something that you can look at in terms of the practical side to make things work. And what's also very, very important for people to know is go for the cheapest deal, right? The cheapest deal will always help you. A lot of people come to me and say, look, my bank is offering me 5%, right? and they say, I don't need any documents, I just want to go for it, right? But there might be another bank who will offer you 20 basis points less, right? They might offer you 4.8%. So, but why are you going for the 5%? Because you might end up paying, I don't know, 40 pounds more for a month, right? Or 100 pounds more if the loan size is bigger. But that 100 pounds, if you're struggling to pay your mortgage, is definitely going to help you, because that's 100 pounds less to worry about when it comes to paying your mortgage. So that's something that you can look for. And these are like very funny times. I strongly suggest people speak to advisors. You can speak to us, or you can speak to another advisor or your bank, because these people can guide you during these times, because these are situations that we are not used to. Like you said at the beginning, we are used to paying 1.5% interest rates, right? Now suddenly everything has changed and you have to change everything all over again. So you might need a financial advisor, or you might need a mortgage advisor, or your bank. Speak to someone who knows about the subject and who can help you.
So if they're just talking about the interest rates which you just mentioned, well, people can find rates at 4%, and that might appear to be the cheapest deal, and there are rates at 5%. But sometimes people find it difficult to choose between these rates, especially when a 4% rate has a product fee of say 1499, and the 5% deal probably has no product fee at all. So how exactly do they have to approach when choosing, or rather or when comparing these two products? How exactly does it work?
Okay, very good question. So the cheapest deal in my mind looks at all of these components, right? So you look at the interest rate. So for example, like you mentioned, it's 4%, right? So 4% might not be the cheapest, even though there's a 4.1% out there, that might be cheaper because the product fee is less or product fee is zero, right? So you need to take that into account as well. So how I look at it is, I look at three components. I look at the interest you pay during this term, like let's say you do a 2-year term, take the interest to see how much it costs. And then add the product fees and any other associated fees. So that's the second element I would count. And the third one I would say is check your mortgage balance at the end. Because if somebody is paying 4%, they are likely to have a lesser balance compared to somebody who is paying 4.1%. Because remember, you pay more interest than capital in your initial periods, right? So therefore, you got to check that balance as well and look at the difference. So if you add those three components together, you will know exactly what your cost is, right? So then you can make that decision. Again, if you're not sure, a lot of advisors should know how to do this, but just don't look at just the interest rate. When I say the cheapest deal, you always look at these three components.
So if you're not quite sure as to how to make these comparisons and make the most wisest choice, it's always best to speak to your advisor. If not, we can help you as well. Our contact details are down below in the description box. But make sure that when you make the decision, to make an informed decision. So now let's move on to the buy-to-let side of things, because a lot of buy-to-let investors or other landlords might be interested in knowing what's happening in the market. So what are the buy-to-let rates looking like at the moment, Ifti?
Okay, so the buy-to-let interest rates traditionally has been more expensive than a residential mortgage. So because what happens with buy-to-let is the banks carry a higher risk, because you're not living in the property. So the landlord doesn't live in the property. So if you're owner occupied, it's generally considered slightly less because it's your house and you look after. But if you have tenants, it's compared to a residential mortgage, it's expected to be a little bit more higher risk. So therefore, banks will always charge you an additional margin, right? So if you look at a thing like a HMO, it's even worse, right? Because they charge you a higher margin because tenants come and go. So that's how it operates. So obviously it's higher. So if you take the residential rates hover between about 4 and 5% now. There is a lender who offers less than 4%, but most lenders offer between 4 and 5%. I'm talking about the high street standard lenders. But then buy-to-let always has about a 1% top up, right? So you pay a little extra. It might be a little cheaper on the day. So buy-to-let landlords generally pay between about 5 and 6%. So that's kind of the going rate. Now it is high, But like I said, even the residential rates are high at the moment. So, compared to what it was a year ago, it is definitely high. But compared to just after the mini budget at the end of last year, it's not as high. So, the rates have definitely come down. So it's been in line with, what's happening in the residential space as well, because these rates have kind of dropped as well.
Right. Yeah, I think the buy-to-let investors or landlords have had a very tough time last year. So thank you for shedding some light on that. If they hopefully things should get better over time for everybody. If I very well remember you making a video on buy-to-let stress testing. I think it was under the topic of stress test causing chaos in the buy-to-let market. So has the chaos reduced now? I know you said the rates are coming down, but in terms of the stress test, I'm pretty sure landlords are pretty much stressed out about this. So could you kindly shed some light on that as well?
Okay, yeah, I remember doing that video. It was a stressful time for sure, but things have eased a little bit. Of course, the interest rates hasn't dropped drastically, so the banks have not made big changes yet, but the banks have been a little careful here, because what they have done is they have offered people with, longer term deals, better stress tests. So it has worked for some people. Banks also look at things like reversionary rates or standard variable rate, we call it. That's the common term that we use, or that's the bank's internal rate. Because sometimes they use that as a stress test where people look at variable rate mortgages, like a tracker. So those seem to work for some people. So there are some alternatives popping up. Another common one we find is top slicing. So with top slicing, even if the stress test doesn't work, the bank looks at your earnings. So if you are earning a lot of money, they say, okay, fine, the test test doesn't work, but you can compensate if there's a shortfall. So they look at it that way as well. So we are seeing banks, coming up with solutions to overcome this chaos, right? So it is definitely getting better, but what we are hoping for is for it to, be better than what it is now, because they used to stress test at 5.5%, but now the stress test, a lot of banks use 7%, some use 7.5%, some even more than that, right? So it's got better from about 8.5%. There are solutions now, but it's still not in this original position, right? So where people borrowed maximum, they might have a problem moving to other lenders. But we are hoping and praying and keeping our fingers crossed that things get better in this space. I think with rates slightly dropping, banks might reconsider this proposition as well, because we are already seeing that happening, but we want more and more lenders to do that.
Right. So all the landlords out there, it may not be all bad news. I know stress testing can be very stressful times, but we can see there's some sort of ease in terms of stress testing. So hopefully that should be the case going forward. Thank you very much, Ifti, for explaining all of this information in detail. I'm pretty sure many of you people will find it very useful. So some of the key takeaways from our conversation today, I would say, would be: number one, be proactive. Number two, be calm, don't panic at all, it's going to be fine. And number three would be my final key takeaway, that will be speak to your advisor or speak to your bank and see if you can ease things for yourself, because definitely the market will get better at some point, and we are seeing signs of it getting better. So once again, thank you, Ifti. Thank you for watching this video. If you like this video, give us the thumbs up. Share this video with your families and friends, because definitely they might find it useful with their own mortgages. And 90% of you have not subscribed to our YouTube channel. So if you subscribe, it'll be awesome. And last but not the least, please click on the bell icon so that you can be notified on the latest and greatest of UK mortgages. I'm Pradesh, signing out from WIS Mortgages Accountancy and Insurance. See you all in our next video. Peace.